9:30 in Washington. It's just gone 2:30 here in a very cold Westminster, here at the House of Commons. Welcome to this month's global webinar for the Parliamentary Network on the World Bank and the International Monetary Fund. My name is Liam Byrne. I have the honour and the privilege of chairing the global network. We bring together about 2,000 parliamentarians in 140 countries. And over the course of our work this year, we've set our frame for debate as how we build a world of more green, inclusive growth that is more resilient and shock-proof. Now, as part of this work, we wanted to zero in on what were the three big risks to green, inclusive growth around the world. And we see those as one, climate change, two, the rising risk of corruption, but three, there's clearly a risk around the advent, the introduction of cryptocurrencies. And so in response to requests from our membership around the world, we wanted to host this special parliamentary dialogue session with the World Bank and the International Monetary Fund on the future of finance, the future of digital currency, and the future of cryptocurrency. And I'm absolutely delighted that we've got a first-class panel to help us get stuck into some of these issues and to help us explore some of the questions that we as parliamentarians will need to be asking in our parliaments around the world. So for many of us, the challenge is simply this. On the one hand, we have 1.7 billion people globally who need access to the finance system and to the banking system. We can't build a world of more inclusive growth if we have so many people who are basically unbanked. So there's an opportunity here to use the power of digital currency to create access to finance and create access to bank accounts, slashing transaction costs, keeping more money in the pockets of the people that we serve. On the other hand, however, there are clearly huge risks around digital currency and cryptocurrency. There are national security issues in many countries, but the crash of FTX reminds us that there are also really serious regulatory issues. And many of us parliamentarians are debating right now the risk that cryptocurrencies bring to sanction busting, to economic corruption, and to economic crime. We have a bill going through the House of Commons behind me here right now, which is creating a new regulatory regime for how we police digital currencies, for example. So this is a live debate for many of us. So we've got a great panel to help us get to unpack some of these issues. We've got Eric Feehan from the World Bank. We've got Tommaso Mancini-Griffoli, who many of you met in Washington during the annual meetings in October, and Bright Simons, who's the president and founder of Pedigree. And then I've got a couple of our colleagues who are going to provide the first response. But then please just signal in the Q&A if you would like to come in. And I will do my best to make sure that we get everybody in who has a question to ask. So without further ado, Eric, I wonder if I could hand over to you. You're the head of Global Macro Financial Monitoring and lead financial sector specialist at the World Bank. We're absolutely delighted that you're able to join us. Let me hand over to you, and then I'll come to Tommaso.
Thank you so much, Liam, for the introduction and for the opportunity to participate in this event. So maybe I can take a step back and just give a high-level overview of how we think about crypto assets, generally speaking. We talk about crypto assets, not necessarily cryptocurrencies, because we don't think that these assets adhere to the general principles of medium of exchange, store of value, and unit of account. So it's very clear that with the recent volatility and the crash of FTX, that this is front of mind, and you also clearly indicated this. So taking a step back, we ask a question: okay, how can these type of assets or currencies really contribute to financial inclusion or cross-border payments? How can they make those more efficient and more accessible? And I think with what I just said, it's going to be very challenging for these type of assets to fully fulfill that function. The promise there, of course, is that you can store value or you can transfer value to anybody, anywhere with an internet connection around the world without a trusted intermediary, and that has great appeal, and that has the potential of course, increasing efficiency and inclusiveness. But there are many risks and many challenges that we can go into, in particular in many of our client countries in emerging markets and developing economies, where actually usage of these type of assets is quite high, comparatively speaking, and so there's a lot of potential for fraud, for scams. So there are consumer protection issues, there are financial stability issues, and for our client countries also issues related to potentially, in an extreme case, currency substitution and undermining of monetary sovereignty, the erosion of certain capital controls that they need to maintain macro financial stability. So there's quite a broad set of issues around these assets. So I think what is important is that we have a global regulatory approach to these crypto assets, and many standard setters are already working towards that. Financial Stability Board, Basel Committee, and others, and the FATF very important for financial integrity reasons. But we're not there yet. It's really early days. There's a lot of arbitrage. And the failure of FTX just showcases that we have a new set of intermediaries that pose risks that are not properly governed, controlled, are intransparent, have conflict of interest. So it just goes to show that we really clearly need a concerted effort to address the many risks in the system. At the same time, I also wanted to say more broadly is that there are many other digital finance solutions that provide promise to financial inclusion and broadening and making remittances cheaper, etc. And that has to do with digital payments and digital money, generally speaking. Central bank digital currencies is an important topic in that umbrella of issues as well. We are trying to work towards improving, for example, payment systems, making them faster, using QR codes. So we also have more people that can enter the fray and participate in the formal financial sector and improve financial inclusion and cross-border remittances. So this is kind of a bird's eye overview from our perspective. But let me stop here and hand it over to you, Liam. Thank you.
Excellent. Thank you so much for setting the stage in that way. You've really unpacked many of the issues that parliamentarians are thinking about and worrying about. Now, let me come to Tommaso, who is disguised as Arif Ismail on our screen here. Thank you so much for joining us. You gave us a brilliant presentation and overview with your team in Washington back in October. We really appreciated that, and I think that gave us a good sense of some of the issues that we're going to have to figure out over the years to come, because I think for members of parliament, one of the big takeaways was that this is an issue that we're going to have to stay close to and engaged with for some years to come as digital currency evolves. But Tommaso, let me hand over to you.
Thanks very much. It's a pleasure to be with you and to see many of you again. I think this is an incredible initiative that you're running, and I'm very happy to be part of it. I'm really here for you to answer your questions and your concerns, and I'll keep these introductory remarks very, very brief so that we can really get to the questions. At the fund, we are taking all of this digital transformation very seriously. And we're looking very carefully at public solutions, central bank digital currencies, for instance, and whether these are appropriate for countries or not. And we're also looking at private solutions. So from the stable coins to the unbacked crypto assets, which are very risky speculative instruments with very little macroeconomic value, and to tokenized bank deposits. So commercial banks are increasingly thinking of leveraging some of the technology that has been introduced in the last years. So there's really a very wide spectrum of possibilities, and some are riskier than others. Some require more capacity and involvement of the state than others. I would just say that one area where we're especially focused is cross-border payments. So cross-border payments they're expensive. They're opaque, they're slow, they're not available to many countries. And the question is, how do we improve them? Or can we leverage new technologies to improve cross-border payments? And of course, there are private sector solutions. So you might buy a stable coin in country A, send it peer-to-peer to a wallet in country B, and then that person somehow spends it. But while the transaction is low cost, the stablecoin may not be very stable. It may be costly to onboard, to actually buy that stablecoin. And then when you get it in the other country, you may not be able to spend it. So you may have to convert it as local currency, in which case you incur an additional cost. And so there are additional hidden costs that I think make some of the private sector solutions actually less enticing than meets the eye. We think that there's room for the public sector to step in and actually offer infrastructure by way of a platform or platforms to facilitate payments, to start with, in central bank money. So we actually think that there's a role for central bank reserves to be tokenized, so to be written in digital form, and then exchanged on the platform, once in digital form, between participants all over the world. You see, today, if you're a bank in country B, you cannot access reserves, central bank reserves in country A. So there's no market for it. But if you tokenize, if you create a digital representation of reserves in country A and stick them on a platform to which banks in country B have access, they can start to transact. And you can think about creating foreign exchange markets on this platform. You can think of basically facilitating bank-to-bank payments in central bank money, which takes away a lot of the risk, while offering very low-cost services. Now, there are all sorts of hurdles with this, there are all sorts of complications, but you got to start with a vision and then iron out these hurdles. That's the business of policymakers, right? If we waited for things to be perfect from day one, we wouldn't do much. So this is one possibility, and I'm very happy to speak more about these types of cross-border platforms. But just to say one last thing, and that technology can only bring us this far. It's important that we work on and solve issues related to governance, to legal interoperability, to harmonization of regulatory standards. A lot of the solutions, technical solutions, can be implemented or will soon be able to be implemented. But without the agreements on governance and without the agreements on harmonization of rules, it's going to be very hard to make progress in this space. So I think that that could be another topic we can discuss today, is how to get rules and regulations aligned between countries. So anyways, that was just by way of an introduction, a teaser, wonderful, if you wish, but very much looking forward to your questions.
Excellent. And I know you're monitoring this quite closely at the IMF, and I know that you're having to provide quite a lot of bilateral advice and assistance as countries and central banks begin to embark on this journey. Just give us a sense of how many governments, how many central banks around the world do you think are now running these sorts of pilots at scale, or sort of scale?
Yeah, so more than 100 of our member countries are actively exploring CBDC. It doesn't mean that they're going to do it. It doesn't mean that they're running full-scale pilots, like China, for instance. But they're exploring actively, which means that they have little teams set up. They're going through the literature. They're meeting with us and exchanging ideas with other central banks around the world. They may be starting to put together basic pilots, basic testing. And certainly they're thinking about how to overhaul their central bank laws and their regulatory frameworks so that these are ready in case the central bank wishes to go through. I'll just give you one last number, and that is this fiscal year alone. So for us, the fiscal year starts in May. We will have worked with about 50 countries, 50 countries, on CBDC around the world. So this is a very new topic. It's important that countries learn from each other, and we are here to help to facilitate that.
Thank you. I really appreciate that. I just wanted to make sure that people had a sense of just the scale of this now underway around the world. Super. So we now come to Bright Simons, president and founder of M Pedigree. who is going to help us finish setting the stage before I then come to my friend John Baptiste from Uganda, who's going to open the bowling for our members of Parliament. But Bright, let me give you the floor now.
Thank you very much, Liam. And I'm delighted to be here, of course. My role is to try and provide some area studies flavor to this. So narrowing down into one region to see if that brings some additional insights. My region is Africa. And so I'm going to try and tweak this within the African context. First of all, there's a lot of interest. 17 countries on the continent doing various things from retail level to wholesale and central bank development, digital currencies. And primarily what we've highlighted are those projects that are sovereign backed. So there are a lot of subnational and sub-governmental projects as well, but these are the ones that are sovereign backed. So 17 right there. The second fact to note is that Africa also has the highest ratio of retail crypto transfers, which maps quite well to remittances. So in that sense, you could approximate and say that it's the content that has embraced crypto remittances the most. And that is impressive as well. If you did a kind of shallow survey, you did some kind of perfunctory survey of the terrain, you might leave with the impression that right now the continent is some kind of regulation desert. There isn't much going on from a regulation point of view, but that's not entirely true. In actual fact, even the IMF is a little bit back out of date in the sense that it hasn't captured Botswana, Eswatini, and Seychelles, and a lot of countries that are actually putting out regulations to govern crypto. So on the regulatory front, on the government front, there is significant progress as well. And what you will often find in general surveys of the literature is often that Africa is not well covered. Why are Africans interested? Why is there so much activity on the ground? Well, two main issues. First one, currency pressures. If you look at this chart, all the major African countries, the big growth poles, your Kenyas, your Nigerias, your Ghanas, also the ones that are facing the most depreciation this year. So some countries are doing slightly better, but the majority are doing very badly when it comes to currency devaluation and depreciation. And they tend to also be the growth poles. Ghana, my own country, has seen more than a 50% drop in the currency with a bit of rallying happening right now. So there's a view that somehow the strong dollar, which is highly subject to US federal rates, dynamics, etc., is not a right way to run an international currency system. American regulators raising their rates shouldn't have such a devastating impact on African countries, for instance, is one argument that has been made. So digital currency could be one way, especially if you have it with a basket of currencies for trading and things like that. The second one is the cost of monetary transactions, which has already been raised. So already Africa is the continent which has countries with the highest dependence on remittances. You're seeing almost 30% there for Liberia. The equivalent situation in Philippines is about less than 10%. And in Mexico, it's less than 4%. So people typically think, the Philippines and the Mexico are high-powered centers of remittances, but there are African countries that are far more dependent. But the costs in the region, especially in terms of intra-regional transfers, are massive, as you can see on the right side of the screen, with countries like Tanzania sometimes going above 20% of the cost of what you are transferring. All those factors have led to a strong interest in modernizing payment systems and creating cross-border solutions that work. On the fiat level, so basically in terms of normal paper currency, we have something called PAPS, which the Afreximbank is pushing. And the idea was to try and stop the $5 billion of money that leaves the continent to correspondent banks around the world when you want to move money from one African country to another. The truth, though, of course, is that it's not the protocol or the technology, which is the actual hindrance. And if it was just for that, SWIFT, GPI, that's brilliant. It's really the institutional arrangements that so far haven't really changed a lot. So a lot of banks really are charging too much margin and things like that. The real opportunity with crypto and with digital is the opportunity for institutional reimagination. And that is really the thing here. And we have an embarrassment of riches of how we can do it from token to account, but each combination creates new legislative requirements. And that really is the issue here. The legislative frontier is expanded by the sheer range of what you can do. And some of the connectivity opportunities are kind of impressive. So we've talked about greening. And if you think of asset-backed commodity structures and structured finance in commodities, tokens would be great. Why? Because you can do instant settlement, which has been a big challenge. In short, the legislative frontier is heavily expanded. The key issue to consider is a crypto transaction or a digital transaction actually legally valid? And in that sense, there is a lot of issues we gloss over about legal tender because they date back for hundreds of years. And now we reinvent it. We assume it automatically moves from banknote to that, but it doesn't. Bank deposit, credit management, all of these raise really critical issues around the extant law. And I'm happy to go into it in a bit more detail as to how that applies. And then lastly, there's the issue, of course, that if you want to do it regionally, then yes, FATF is already putting together quasi-treaty type arrangements that are already having an impact. But the truth is, we're really going to have to see some actual treaties coming up very soon. And I think it's in the area of cyber fraud and in the area of cyber security risk related to crypto, attempts to recover assets across borders if you fall victim to fraud. Things like that, I guess, are less controversial and perhaps could be the basis of an emerging set of treaties soon. And that is where parliamentarians, I think, ought to be focusing when it comes to the cross-border dimension. Whereas internally, there are a lot of practical issues to solve. None of the African countries that are doing this so far have gone to parliament to actually get a legislative framework in place. So there's huge opportunity. Thank you.
What a brilliant overview. Thank you so much indeed for providing that. That presentation will be of huge value and interest to all of our members. So we've now set the stage for our parliamentarians very nicely. So thanks to Eric and Tommaso and to Bright for helping us do that so eloquently and leaving us plenty of time. I'm going to come now, I think, to John Baptiste, who I think is joining us from Uganda. But I also, I think, have Paul Amara with us as well. But let me bring in John Baptiste first, who, very good to see you again. Thank you again for joining us. And thank you for agreeing just to open the batting for the parliamentarians with any questions and issues that you've got. Oh, have I now lost John Baptiste? There we go. Over to you, sir.
Thank you. Thank you very much. I think this is Paul O'Mara.
Paul, I'm sorry.
Yeah, thank you. John Baptiste has some commitments and he has not been able to come.
You've stolen his phone. That's excellent. Thank you.
Yeah. Thank you very much. I am actually happy to be here. This is my first. I'm a member of the Budget Committee of Parliament of Uganda and also a member of the Finance Planning and Economic Development Committee, which is basically responsible for legislation of regulatory issues relating to our banking system and also matters relating to the central bank. This subject is quite an interesting one, the cryptocurrency and digital payment systems. In Uganda, we have had challenges. Number one, because it has not been supported by the central bank. And the issues that has been raised is around control of monetary policy by the central bank, the ability to maintain our reserves for the country, and also elements of managing frauds, which has been mentioned. So the late governor of the central bank, Professor Mutebile, in one of the discussions where we had in the country regarding the cryptocurrencies, he actually said, as the central bank, they are not in support. And the president of the republic was there. The president is in support, but the late governor, and I think the central bank as an entity, was fearful. So I think what we really need to do across the world, especially to enhance legislation, we need to bring the central bankers into the game. And the alternative of using the central bank digital currency would be a very nice way to start, because that is mainly within their domain. They can issue the currency in terms of digital tokens, and then we can create the the digital transactions, and people will be able to transact freely. But I think a very important issue has been raised. In Africa, we spend a lot of money in transactional costs, cross-border. And so if you make payments in US dollars, you might actually find when it is landing at the final destination, it has 3 currencies would have been gone. And the exchange rates, charges will happen across the board. But the moment we use digital currency through blockchain, there's actually the transaction cost is cut completely down. So we really need to have the knowledge gaps bridged, especially for parliamentarians to appreciate that. And also we need to bring the central bankers on board. They are always the laggards. We need to make sure we bring them on board, and so that they begin to appreciate the technology going forward. So like in Uganda, for example, to enhance financial inclusivity, especially for our rural people, we are currently using mobile money transactions, which is using mobile wallets, which later on you have to eventually when you do the payments, you have to get the physical cash itself, or you actually empty that wallet to somebody else's wallet. So the wallet system is working. So if we can use the wallet system for mobile money transactions, then for digital currencies, we can achieve the same milestone as well, because this one will be actually real currencies being exchanged, not only in Uganda, but across the world. It becomes a global acceptable currency. So what we see here is between individual, the retail transactions is happening with the citizen, because they don't need the central bank. The central bank is completely put off in the system, and they don't like it at all. And so individuals are doing cryptocurrency transactions without the central bank. It's a silent thing which is going underground. But the central bank, where they're sitting, they're saying, "We are warning you, please don't get involved in these transactions." So as I mentioned, it is a very important thing. I believe strongly that digital currency or digital transaction is the future. There are a lot of risks associated with it in terms of frauds happening and the volatility with those currencies can happen so quickly, and there's a loss and gain. So those are the kind of the pitfalls that we see. Thank you very much.
Well, fantastic. Thank you very much. And what's so important about this area is that we have parliamentarians around the world who do understand the issues, because it's such a new field of policy. There aren't going to need to be legislative and regulatory changes. Parliamentarians are going to have to know about this in order to get those regulations and those new laws right. But just listening to you, Paul, you make me think that there may well be organisations that we can draw in to support us on this. It could be the Interparliamentary Union. It could be, for some of us, the Commonwealth Parliamentary Association. There could be other spaces where we've got legislators coming together to try and share good practice when it comes to new laws and new regulations. Right, we're going to go to Bahrain now. I'm going to try and bring in Redha Faraj, who has raised a hand. I'm going to try and group a few questions together and then come back to our panel.
Thank you.
Hey, how are you?
Thank you very much. Fine, I'm very good. I do totally agree that the solution to this issue which we have cannot be individual countries, and especially the sort of the developing and the poor countries. So therefore, the approach should be very global. For solving or coming up with a solution surrounding everything, the digital cryptocurrency or anything called tech, fintech, prop-tech, and whatever tech is sort of are there. Because these are all technologically innovative digital transactions, which is a must. We have to go forward, and these are needed. So to effectively resolve this, I think it has to be a global approach. The question really is that all the really developing countries and poor countries need also to be involved in the discussions and the trainings while this process is going on. Is it fair to assume that the World Bank and IMF and other more advanced economies would take this role and involve the developed countries and the poor countries in their discussions with coming up with a global solution? And at the same time, you would somehow equip the parliamentarians in those countries with two things which is needed: the knowledge, the training, and the procedures, whatever sort of really needs to be developed, while you are discussing to equip them to be able to introduce legislations which would be in line with the global thinking and ideas, and at the same time, it serves the purposes in those specific countries.
Yeah.
Have I made myself clear, or am I not?
No, you definitely have. That's extremely important. Let me, Gagano, I don't know if we've got any other parliamentarians.
Thank you very much. That's it.
Thank you, Faraj.
I would like also to thank all the participants as well as sort of really your presenters, because I think the sort of with this briefing which we started with, I think it has made the whole topic very clear of how we should be all thinking about it, because now every sort of country or every parliamentarian is thinking at it from a different angle and a very narrow angle. The sort of issue is not narrow, it's a very global and big. So therefore we have to think big. Thank you. Yeah, absolutely. I think it would be an error if we all tried to solve these things on our own without talking to each other. So we've got a few questions that have come up in the chat as well. So I've got, let me try and crystallize some of the questions back for our panel, if I may. So I think Paul very clearly set out some of the benefits, particularly for Africa. I'm sure many of those benefits that Paul enunciated for Africa are true for other countries as well. So it would be good just to hear what are the 2 or 3 real big benefits. Does it come down to just saving transaction costs? What are the other big benefits? I think second, what does the panel think about whether developing countries should adopt cryptocurrency or digital currency as legal tender? At what stage is that a good idea? And then I think it would be good to get your reflections on the benefits of trying to coordinate some global standards or global best practice on legal reform and regulations. And any thoughts on how we might begin to do that would obviously be really welcome. Tommaso, maybe I could come to you first and then to Eric and to Bright.
Sure, those were excellent questions, very broad questions. Let me then let me take them a little bit in order. So the first is on CBDC, let's be precise. What are the advantages? And then we'll speak a little bit about other types of cryptocurrencies. So, one thing that is really astonishing when I travel around the world or speak to different central bankers is how different the reasons are to be considering CBDC. So I said earlier that we had more than 100 countries considering CBDC. There are not quite 100 reasons, but there are a lot. And some have to do with financial inclusion. So some countries are really after financial inclusion. Now, CBDC is no silver bullet. You have to understand first, what are the hurdles to financial inclusion? And CBDC may help in some by, for instance, lowering servicing costs, reaching those in rural areas, but will likely not help in others, including, for instance, the lack of identity to be onboarded. So if you don't have identity to be onboarded to a bank, you're not going to have the identity to be onboarded to CBDC either. So we need to understand what the hurdles are. But anyways, some are interested in financial inclusion. Some countries emphasize more the payment system resilience and the idea of disciplining the market. So payment systems are increasingly in the hands of fewer private, large sometimes foreign companies, and there's a certain degree of discomfort. And in some countries, a feeling that regulation is not enough, and that introducing CBDC would offer a backup system for domestic payments. And by introducing a low-cost solution, you would discipline the private market to offer something of comparable cost. And then you know, there's some countries that are really all about future-proof. So they see the value in CBDC in setting up a foundation for the private sector to then innovate, create new forms of money, move financial assets to the digital world, pay for them using safe money, so CBDC. And that whole, there's a lot to unpack there. I won't do it now, but unless you want me to, but there's a whole world there related to future-proofing and the role of CBDC in future-proofing that countries are interested in. Now, one important thing that also harks back to what I was saying earlier is cross-border payments. And Paul, I think, said that domestically, it's great. We use mobile money. We transact at very low cost. A lot of people can use it. Let's just use that cross-border or something akin to that cross-border, right? Wouldn't it be nice to be able to transfer money seamlessly across borders? Now, of course, it's a lot harder to do across borders. There are, for instance, very simply put, you need to convert currencies. You have to, at some point, buy the foreign currency, sell the domestic one, and transfer that. Just that is, of course, extremely complicated and actually much harder to do than, well, it raises a lot of difficulties, even in the digital world. Or the other thing is compliance. Will the foreign country recognize your compliance checks? Will they feel comfortable that you have ticked all the boxes? That's also a big part of the cost of cross-border payments. So one big part of the cost is the foreign exchange leg. Another big part of the cost is compliance. So this is where our platform idea comes in, and the idea of, on a platform, transacting central bank, tokenized central bank currencies decreases counterparty risk. Doing this on a single ledger or on a single platform allows for these currencies to be interoperable and to be traded with one another. And then we also have this idea of using domestically compliance checkers. So companies, or that would be specialized in doing compliance and basically whitelisting people as they enter the platform, so then they can transact freely on the platform. But of course, you need to trust those entities, et cetera. There are all sorts of legal complications, but that's kind of the vision. So I think, Paul, you're absolutely right. I mean, that's the direction of travel. It's just a lot harder to get there than implementing a domestic solution based on mobile money. Perhaps just, if you allow me, just say one thing about legal tender, since we've been very vocal about this at the fund. I don't think there's any time, Liam, when cryptocurrencies should be legal tender, for various reasons. So by cryptocurrencies, I mean the bitcoins of the world, unbacked crypto assets that are very volatile, that expose users to large losses, that expose the government and fiscal revenues to large risks. Suppose that you are allowing people to pay in Bitcoin, and perhaps you even set the price of taxes in Bitcoin, but you're paying out most of your expenses in the local currency. The government then incurs a huge fiscal risk. And monetary policy transmission is also at risk. You're basically introducing another currency over which you don't have monetary policy control, and thus you undermine the effectiveness of your monetary policy. So at the fund, we've been quite clear that we do not encourage countries to adopt cryptocurrencies as legal tender. We see that as extremely risky, and the experiments that have been done to date in this space, take El Salvador, for instance, have not been a success. And if you want, I can say a little bit more about that as well. And to close, I'll just say that we're very, very happy to help in knowledge and training. I'm happy to get into the details later as to what that would mean, but I'll just say that the IMF, like the World Bank, has a long tradition of providing technical assistance to countries. We need a letter from the central bank governor to the IMF through the executive director of the fund representing that country and requesting assistance. And normally we are able to help in one way or the other. And we can help in the area of regulating crypto assets. We can help in the area of evaluating CBDCs. We can help in the area of cross-border payments. In fact, we have an explicit G20 mandate to do that, specifically in the area of cross-border payments. So we're very happy to get in touch, to help, to field the mission, to put you in touch with other countries and experts. Just ask.
Perfect. Great, Motto. Thank you so much. Eric, let me come to you next.
Thank you, Liam, and thank you for those good questions. Tommaso said many things already, so let me focus on a couple of areas. First, on benefits and looking at root causes that prevent financial inclusion from reaching higher levels. We have already seen an increase in financial inclusion in our Findex data, which is our triannual exercise, has borne out that we see increasingly use of digital payments and an increased penetration of financial inclusion. But often there are basic stumble blocks such as trust in the financial sector, geographical distance to, for example, a branch, the lack of documentation, or the cost of products, or the suitability of certain financial products, or financial literacy. Those are very basic stumble blocks, and digital solutions can help, whether it be e-money, mobile money, stable coins, central bank digital currency. It doesn't matter. Some technical solutions can help. On the documentation side, for example, there's a digital ID infrastructure that can be interoperable and link to accounts and make verification and transactions easier. Geography will be addressed by being able to make transactions on your mobile. But the trust issue sometimes cannot be alleviated fully, nor can the cost be, because ultimately these things need to be commercially viable. And even for a central bank digital currency, it needs to be operated by an infrastructure that is in the private sector. And so it's very important to make sure that it's commercially viable and at the same time suitable for clients. Financial literacy is an important stumbling block in many emerging markets and developing economies, and no digital solution will necessarily address that. Also, there's a preference for cash. I mean, when you look at the current state of affairs, most emerging markets and developing economies are still very much cash-based. That will not change in the foreseeable future. Yes, there's a trend towards digitalization, but that's a long period. And even when you look at mobile money, there's not much acceptance by merchants of mobile money and e-money. Most of it is just used for cash out and cash in transactions, and not necessarily to buy your groceries at the store. So digitalization in and of itself is not a panacea, is not a silver bullet. It requires a broad range of effort, legal, regulatory, and also on the consumer side. So that's some of the financial inclusion issues. A point on legal tender. I also want to be very clear on using crypto assets as legal tender. I mean, taking a step back, many countries have faced macro financial volatility and a lack of credibility of monetary policy. And so sometimes de facto or de jure, we have seen dollarization, and dollarization is a very well-known phenomenon. But ultimately, that's a liability of a central bank, and there's more control around it. And this is something that is completely absent in the context of an unbacked crypto asset such as Bitcoin. So it raises a host of risks: consumer protection, operational, monetary policy, risks in your banking sector, which then necessarily needs to touch these assets. And there's irreversibility of these assets and many other features that complicate things. I'm not saying that it's not impossible to manage, but it complicates things to a large extent. Also, in some cases, there needs to be backing of the state to make sure that there is an exchange of the crypto asset into something else, and that creates contingent liabilities. So legal risk, consumer protection risk, financial stability risk, financial integrity risks are also very important, and financial integrity risks related to money laundering and terrorist financing. So that's very good. So I talked a little bit about the financial inclusion point that was put on the table, and that digital is not necessarily a panacea. Talked a little bit about legal tender. There was a question about global standards. I think coming back to crypto, I mean, this is a very nebulous concept. We have unbacked crypto assets, we have stable coins, and then we have a decentralized ecosystem that's called decentralized finance that offers blockchain-based financial services, exchange, lending, derivatives, etc. So it's very clear that given the inherent global nature of this phenomenon, there is a very easy race to the bottom where you can have new intermediaries that go to jurisdictions with the lowest regulatory denominator, and that can then lead to all kinds of challenges. So you see global standard setters spearing into action. Financial Action Task Force was leading the charge and has already put together new binding rules and guidance that has come out, but implementation is clearly lacking here, and that's a challenge. So that scope for international regulatory arbitrage for financial integrity is still there. The Financial Stability Board has done a lot of work in terms of global stablecoins and their financial stability impacts. There's also now in October coming a few papers came out on unbacked crypto assets and what the regulatory, supervisory, and oversight implications are of that. There's also the Committee of Payment and Market Infrastructures that has opined on the application of its principles to stablecoin arrangements, particularly those stablecoins that are systemically important and of a global nature. And then we have also the securities regulators, international organization that has put different reports out, first on crypto asset trading platforms, and that has turned out to be very prescient, given recent developments, how there's conflict of interest or on these platforms, or commingling of assets that belong to consumers. So there's a combination of offering of activities that create conflict of interest, no Chinese walls between different activities, etc. So I think to clear there is on the global side to create one a regulatory framework that's harmonized and coordinated. That's one. Two is really to make sure that these crypto asset service providers are brought into the regulatory perimeter that will also increase transparency and reduce the data gaps that we now see. And really thinking about stable coins because they could have large scale and have a systemic footprint. So that's on the global standards. Then the last thing that I wanted to mention is what we do. We provide technical assistance. We talk to a lot of countries, be it in the context of CBDC or in the context of crypto assets and what to think about them, what to do about it. So there's a lot of dialogue, technical assistance looking at draft legislation. We contribute in these standard setting bodies, of course, providing from the World Bank perspective, the emerging markets view. We do a lot of analytical work, reports that we will be happy to share. And an important diagnostic vehicle that we have together with the IMF is the Financial Sector Assessment Program, where more recently we are also incorporating digital financial aspects. So we look at fintech broadly speaking, but also crypto assets. So we are in continuous dialogue with our client countries, and as Tomasa was also saying, our door is open, and we're very happy to continue that conversation. We're there. So let me stop here and hand it over to you, Liam.
Perfect. Thank you so much. We've got questions coming in from around the world now, and I'm not sure we're going to get through all of them, but let me just bring in a couple more of my colleagues, and then I will try and summarize some of the questions that we've got literally coming in from every point on the planet. If I can just come to Karen Cummings first. Karen, you've got a great question here about just the crime risks, especially when it comes to cross-border payments. But many of the questions that we've got coming up here do centre on how we make sure we've got good systems for tackling crime, tackling fraud, and crucially, not just writing standards, but implementing new laws. But Karen, over to you.
Yes, thank you very much, Naima. I thank you very much for those exciting, insightful presentations. Very informative. I think my question was partly answered before, but I was just wondering, of course, there's an adage in colloquial parlance that the smarter the government, the wiser the population. And so I was just wondering to know if efforts are being made to make this cryptocurrency across borders less appealing to criminals. But I think the penultimate speaker spoke about they're available. The mandate of G20 was to ensure that central government to work with IMF so that we can have, they can help us in the regulations and ensure that is minimized. So I'm following the trend of thought, but I think it's an idea in the future. It's futuristic. And I think it's something worth considering. So thank you very much.
That's interesting. So Karen, just tell people where you're calling in from.
I'm from Guyana. Guyana. I'm a member of Parliament. I'm a medical doctor by profession, public health specialist. I'm chair of the Social Services Committee in the Parliament. Thank you.
Yeah, thanks. And so you could see this as something that could well be happening soon in your country, or it's something
Absolutely.
that you have to think about for your future.
That's right, because Guyana has now found oil. We think we just above, below US and above US and just below Russia. In our newfound oil, Guyana is in South America, and we have less than 1 million people, and so we're becoming a kind of golden oil rich country now. And so this may very much be under consideration.
Yeah, fantastic, great, thank you so much. It's great to have you with us. Let me come to Brian Cambiozzi now, because Brian just wants to pick up on this question about central bank reserves potentially being available, more easily available, especially during liquidity crises. But Brian, can you hear us? Can you join us?
Sure, thank you very much. My name is Brian from the Parliamentary Assembly of the Mediterranean in San Marino. And I wanted to ask you if you can deepen more at the point regarding faster and cheaper money transaction, especially regarding central bank reserve in period of liquidity crisis. In particular, how much this could positively impact the central bank in period of macro-financial instabilities, and also how it can affect the private banking system, considering the persistence of physical transportation costs. Furthermore, is there any evidence that it might temporarily aid bank institution during a bank run in the short term?
Perfect, great, Brian, thank you so much. And let's go back to Ghana now and back to Paul Amara.
Thank you very much. Can you hear me?
Yeah, you're good.
Yes, thank you very much. There are actually two questions. I think mainly, I think to Eric. Just to let you know that recently we had to deal with the FATCA ratings for Uganda, the Financial Action Task Force, because of some of the regulatory issues regarding terrorism financing, money laundering, et cetera, et cetera. So it speaks to the elements of financial integrity. Now, how does adoption of these cryptocurrencies be, harmonized with some of the very key standards being set by FATCA? Because with the new regulatory framework which we put in place, you really need to know individuals, the directors, the companies, where they are located, so that we can know exactly who is doing this type of business, who is undertaking this kind of transaction. So when you basically move into a cryptocurrency and digital money environment, these are seamless, they are faceless. So how would we be able to harmonize and know that this is not terrorism money? That is one. The second one is around a legal tender. Because if you have seen, we have tried dollarization across the world. And recently with the war in Ukraine, the Russians are now saying, no, we are going to look for alternative currencies, maybe yuan and so forth. How do you then begin to adopt a cryptocurrency? And with all the attendant exchange rate risks, and who will be in charge? How do you do that, given that every country has its own monetary policies and framework? And also given the recent FTX collapse in the US. Now, which currency would you prefer becomes a currency of choice? Because dollarization, we know it because the US Central Reserves basically controls the monetary policy regarding the dollar. But if you take into some of the currencies, the cryptocurrencies, who will be in charge? Do you give it to the private sector who is putting this currency in place? What about if it collapses like the FTX that we have seen recently? Thank you very much.
Paul, can I just ask, when you think about the future of Uganda, I mean, do you see digital currencies as something that is going to become much more common and more widely rolled out in Uganda?
It will take a lot of, as somebody mentioned, that this cannot be left to a country to determine. Like if you look at the Basel I, Basel II, it's a global phenomenon where everybody is responding in unison. Now, as I've given you, the FTX collapsed recently. For example, if you were hosting the digital currency or the cryptocurrency, whatever it is, and then it collapses, because that is out of the domain of the central bank, the Reserve Bank of that country. So the question still is about the trust, about control, about monetary policy, about reserves. And yet there's a need of to reduce transaction costs, to have a seamless payment system. That is a very big need. But the question is, how do we do it in such a manner that manages the risks, and that there is a trusted control behind the enterprise? And as a global community, we actually begin to believe that if we undertake this project, it will all be well for us. Some of our countries are very small, and a moment you begin to use a cryptocurrency as let me say, as a currency, as a legal tender rather, then you have to be sure that it becomes a store of value. So in case something goes wrong, then you have lost the nation's wealth. And so for me, I think the question would be, if we are going to go along this route, it must be a trusted option like gold, like dollar, so that we don't lose value. That if something goes wrong, we don't collapse completely.
Yeah,
our reserves is small. Is a $4.6 billion reserves. Now, for example, if you put that in a digital currency, and then something happens, then the country remains with zero in terms of control. So those are things that we really need to think about carefully. But it's something which is welcome as long as there's harmonization, there's a global of understanding that this is a trusted currency that we will all go in. We understand how it's going to work. It will be something that is why the idea of bringing parliamentarians together, and we ask all the questions and take all the T's and all the dots, then we'll be able to proceed, with the new options.
Yeah, perfect. Thank you.
Thank you.
I'm really, really grateful for that insight. And then finally, just on this round, let me come back to Bassam Albin Mohammed, who's joining us from Bahrain. A couple of very good points here on infrastructure and governance too. But Bassam, let me hand you the floor and the mic, so to speak.
Good evening, everyone. Thank you for all the very interesting points that have been brought up. As you said, the issues revolve around the governance. I mean, if we do have the proper governance and it's at least agreed upon on the at least basic terms globally, then we would be safer to use these currencies. And also when it comes to the infrastructure, I think many countries lack the proper infrastructure to start using them. In our case in Bahrain, we do use some sort of applications that we could transfer money within the local system, the local financial system. And it made the change of money much easier and the transactions, the trade and other transactions much more visible and widely used by others. So the use of actual cash has been minimized to a much lesser extent. And I think if this is used widely and other countries have the proper infrastructure, I think that would probably serve better the wider global community in that sense.
Yeah, absolutely. And that has implications for development spending and all sorts of other things. Well, look, thank you very much indeed for that. That is a very good set of issues, which our panel are now going to have to answer in great detail and brevity. But let me just summarize some of the issues around cybercrime and cyber fraud, because from my experience, that makes up about 2/3 of the questions that I come across in this debate. And what we found when we debated the new economic crime legislation that's going through the House of Commons right now is that, as some of our speakers pointed out, it's totally related to registers of beneficial ownership and the offshore corporate regime around the world that helps people hide things in layers of offshore companies inside trusts, which in turn will be opaque. If you then throw cryptocurrency and digital currencies into the mix as well, sometimes it gets even harder to try and work out exactly who owns what and when. The big challenge then on implementation is really significant. So we have a pretty good police force in our country. We're very lucky for that. But we recently cross-examined the City of London police, who take the lead on fraud crime here. And the challenge that they put to us is that, look, well, you know, a sergeant with specialisms in cybercrime might earn, I don't know, about £38,000–40,000 at best here in the UK. If they go to the private sector, they earn £200,000. And so it's very, very difficult for police forces and crime agencies to actually keep hold of many of the people that they need in order to police this space effectively. So as parliamentarians, we don't have to worry simply about getting the law right and getting the regulation right. We have to worry about protecting the integrity of our reserves, and we have to worry about whether we can actually implement the law, given the complexity of some of these issues. So those are some of the things that have consumed much of the debate here in London. Right, let me come back to the panel for any kind of reflections on that very wide range of questions. And Bright, perhaps I could come to you first. And if there was anything indeed in the last round that you wanted to pick up, please feel free to do so.
Thank you, Liam. Yes, I think I'll start with the very direct question that Honorable Mara asked, which is what is happening on the Financial Action Task Force front as far as crypto and digital currencies are concerned. And luckily, there's quite a bit. So there's this thing called the travel rule, where exchanges, we call them virtual assets service providers, are meant to utilize a common framework in communicating with each other. And so transfer of assets between them are to satisfy the full beneficial registry requirements, very similar to what is happening in the fiat system. So there's actually even a protocol, IVMS, that is supposed to guide how you keep track of who is sending what across exchanges around the world. And the exchanges have very cleverly organized themselves into something very similar to IOSCO, called IDATSA. So that's quite a good thing. On the issue of how then do you reconcile that with privacy or data protection, which is obviously a very profound philosophical point, because it's actually easier to track people digitally in some ways. So in that sense, some of the money laundering issues and the rest of it are actually better addressed. But then you have a trade-off, which is privacy. That can be solved technologically, but then it gets more sophisticated. So there is this new idea of the digital twin, where we can literally give you an avatar. We don't know who you are, but all your actions are consistent. So it's very similar to knowing who you are. We just create a gap between your digital twin and your real identity, but your digital twin is consistent. So if that means, therefore, that how much you transfer a week, how much you transfer a day, where you transfer it to, are you sending it to Iran, raises issues that affects your digital twin. And then a court is required to break the link, or rather to fill the void between your digital twin and your real self. So that is an example of a technological model. And there are a lot of sovereign identity models that are being developed with great complexity and depth. The problem will obviously be how do you communicate that to non-specialists in a way that allows actual decision-making to be smooth. On some of the issues that were raised in the previous round, I think some of the more interesting ones are those that are very applicable to Africa, but may not have come up. So one of the advantages of CBDCs, or central bank digital currencies, and here I need to clarify once again to Honorable Mara that there is a difference between just allowing cryptocurrencies to be used in the country, which is one set of legal issues, or which raises one set of legal issues, and the central bank itself issuing a digital currency that it monitors, regulates, and in some cases actually delivers. So it has the infrastructure to deliver. In those instances, some of the issues around control and monetary policy and the rest of it can be managed within the context of the fact that the central bank is the one that issued the digital currency. And so presumably it's done a good job of designing it well. But we can take that for granted as well. So that creates issues around what are the checks and balances within the jurisdiction to ensure that if the central bank is doing this, there are people around the table that understand this into great detail and can provide support to the parliament. So parliamentary inquiries will have to be designed in a way that respects the technical complexities that are at play. On how this then, in an African context makes sense. One of the fascinating things that, most people are not aware of is the fact that even in countries where the digital payment systems work quite well, there's still a lot of movement of cash around. So the Central Bank of Nigeria, the Central Bank of Ghana are massive logistical companies. They maintain vaults at multiple points. They have tracks, highly secure tracks that move the money. And in countries where electricity is a problem, in order to maintain the vaults, you have to move diesel around. All these are huge logistical problems that if you could create a central bank digital currency that gets wide usage, then you will minimize the circulation of cash and therefore the logistical implication that arises. Of course, digital currencies that set in digital applications presupposes that the central bank has an understanding of user experience and user interface. So the current Nigerian situation where the central bank launched the app and then it failed kind of consistently because of user experience issues, create a very interesting new trust issue. So it's no longer trust about the fundamentals around recovery and things like that, but it's whether you can do things well. So it's almost like trust in competence. So if you're a central bank and you're going to get involved in issuing digital applications, more or less you are competing with Facebook. The reason being, the average user nowadays wants the degree of reliability that they can get from a Facebook or a TikTok or whatever. So that is really powerful management of data centers, orchestration of artificial intelligence, and all of these things that governments are not often very good at. Which brings us back again to what Honorable Mara and I think Honorable Kamins also raised, which is the capacity within countries to work with private sector institutions that have this understanding about user experience to actually build things that people will use. Because as you noticed, the Nigerian app has seen very low uptake. I think at last count, only about 400,000 Nigerians are actually using it. So those are very important points. Last point I'll make is the issue around digital rounds and the very brilliant question that Mr. Brian Kambuzi, Honorable Brian Kambuzi raised. So two things. On the one hand, a digital currency, a central bank digital currency, in some extreme scenarios, under some extreme shocks, could facilitate a bank run because people can move money out of their commercial accounts, bank accounts, into a central bank account if they trust the central bank more. So if there is a concern about a particular bank stability, it's easier to move your money from that bank into your central bank wallet. Of course, that presupposes that the law, the central bank law, allows the central bank to issue accounts to individuals in the country, which is a particular approach to cryptocurrency. Token-based approaches are different, but where you have an account-based system, they can move money from their bank accounts into the central bank wallet. And that could create instances where you accelerate the velocity of bank runs. On the positive side, it also makes it easier for central banks to track liquidity distribution to banks that are potentially under distress with such smoothness that you don't actually notice any discontinuities. So you don't even detect that a bank is having challenges with liquidity. Because usually what happens is that you go into the bank, you want 10,000 local currency units. They tell you, can you take 2,000 now and come back later? You call your brother and say that bank is having trouble, and then a run starts. So with the central bank digital currency, there are possibilities that you could smoothen the distribution of liquidity during moments of stress. Thank you so much.
Absolutely fascinating. Thank you very much. Eric, let me come to you and then I'll give Tommaso the last word. But anything there you would like to pick up would be really welcome. And I wonder if you might just say a word as well about how you see the interrelationship between this field of policy work and what the bank has said about the potential for quite radical acceleration of digital infrastructure rollout over the next 5 to 6 years, because this is something that we've discussed as a network before, and there are obviously some quite ambitious ambitions, quite aspirations for how quickly digital infrastructure gets rolled out in places which are currently without connections at the moment.
Thank you very much, Liam. Let me see, maybe before answering that question, going back to the point on crime, which I thought you put on the map as a common thread of many of the comments. So I think as soon as you don't have any face-to-face interactions and you have potentially global reach with any form of digital money, then at the end of the day, certain risks are heightened. So if you don't have very rigorous onboarding programs, KYC, so know your customer, etc., you inject these type of risks into the system. And we see that in crypto assets most dramatically, where crypto assets have been used to evade sanctions, or at least attempt to evade certain sanctions, evade capital controls, or conduct cyber crime. So there are a lot of frauds and scams. So and this is in a sense enabled by these assets. So this is very important to keep an eye on, because it erodes the fundamental integrity, or at least it would risk the integrity of the overall space of financial transactions. So it's no wonder that the Financial Action Task Force in that respect was one of the first global standard setters to really step into the fray and provide binding guidance. And that guidance really focuses on two key pillars. The first one is the authorities themselves. The authorities, even when they decide to ban these type of activities, really need to monitor for risk related to money laundering and terrorist financing of these type of activities on a continuous basis. And that comes to the question of capacity. Capacity is building very rapidly, but there are many resource constraints. So in an environment where many regulators and supervisory authorities are now confronted with a rapidly moving financial sector landscape, be it the entrance of big tech or fast payments or digitalization of cross-border payments, it all needs to be done, and it all needs to be done safely. So in the context of all these different developments going on at the same time, capacity constraints, resource constraints are really important. That's on the educational side, but also the implementation side, doing the on-site supervision, making sure that that supervised entities do what they need to do. So that's the second pillar, really making sure that that any intermediary, be it a regulated financial intermediary as a commercial bank, or a crypto asset platform, or a non-bank intermediary like a payment provider, whenever they touch any any value, and they have certain type of control over that, that they run rigorous and robust onboarding programs, do KYC, do proper due diligence, record keeping, and all the other things that are really required. Because even though many crypto transactions happen on a peer-to-peer basis, at the end of the day, these need to be brought back into the regulated financial system, where you swap any virtual asset or crypto asset for fiat, and that's where regulation needs to be strong to prevent crime and cybercrime in particular, sanctions evasion, all the kind of scams. So I think this is a very important point. Then in terms of digital infrastructure, the bank is very strong on infrastructure, generally speaking. Liam, I believe that you not only talk about financial digital infrastructure, like upgrading of payment systems or interoperability of payment systems across borders, but also the basics of making sure that there is broadband internet, and that people have access, right? Can use their mobile devices to do online banking, for example. So the bank, and those are colleagues that we work with closely, is very strongly pushing towards expanding that infrastructure, physical infrastructure, making sure that it is reliable, that it has the right capacity, but also at the same time make sure that the regulatory and legislative frameworks are in lockstep. Data privacy is becoming a really important topic, consumer protection, a lot of mis-selling. So these are aspects that are very, very, very important to look at as well. When it comes to financial sector infrastructure, what we really see is very interesting developments on trying to tie these things together. So you have a credit registry, and you have governments having certain information about their citizens, and then you have banks that sit on top of transaction data and all kinds of interesting information of the consumer. And how can you tie this together to provide better financial services to individuals, make them cheaper, make them more competitive, while at the same time being subject to consumer consent and data privacy, so that people are protected. And this is a very important balance of these benefits and these risks. And I think this is one of the frontiers where the bank is working very, very closely these days. So anyway, let me stop here.
That's super useful. But Eric, presumably the bank will be in a position quite soon to begin pulling together what looks like best practice in, say, tackling cyber fraud or tackling cyber crime or maximizing rollout of digital broadband infrastructure. Presumably, there are case studies and good practice that you will soon be able to collate and share, if not already.
Absolutely, Liam. And as a matter of fact, we have already put out some material on consumer protection issues specifically. And that also goes back to an earlier point that I made. It was literacy, etc. So we have put out reports that link consumer protection to digital financial services. And of course, crime is there, but there's also issues around algorithmic bias that can exclude certain people. So we are very strongly looking into that. And then when it comes to the infrastructure, we have an entire digital practice. So that sits separately of where I sit. That just looks at these things to make sure that it's there, that the regulatory frameworks are there. And we put out a World Development Report, I think it was 2 years ago, exactly around the topic of digital information and digitalization, that already collates some of the best practices in this area, including the tensions between privacy and efficiency, competition, and on our side, meaning financial sector, financial integrity.
Yeah, fantastic, great. Thank you so much. And Tomaso, let me come to you for the final word on this, and let me just throw in a couple of other bits and pieces that have come up. So one of our members of Parliament has asked, in addition to what you've already heard, just try and crystallize why central banks need to intervene in digital money transactions between individuals. You've talked a bit about that, particularly some of the trust issues But anything more that you can say on that would be super useful. And then there's this intriguing idea of a great IMF invention called special drawing rights, which in a sense is a kind of a global currency. Can you foresee one day, when people have central bank accounts perhaps, but the currency denominated is an SDR rather than a local currency? Or is that just a step too far? Anyway, I'll let you pick up what you might like to pick up from that.
No, thanks very much. Thanks very much. I'll certainly address those questions and perhaps say just a few words about some lingering points because there's been so much wealth from the questions asked. There was a question on bank runs, and I completely agree with Bright that being able to provide liquidity is actually a great way to answer the bank run. So if you're in a position to be able to reassure people that they'll get their cash or their digital cash easily, you might dissuade, or you might keep people from running. But I think that the bank run is only one aspect. That's the rapid movement away from bank deposits. You can also call it a jog or disintermediation in steady state of commercial bank deposits. So if you introduce CBDC, or if you introduce a very, very safe stable coin that is perhaps backed with central bank reserves, there might be the incentive for people to take their money out of the banks and hold that instead, even without having concerns about the solvency of the bank. And so there is a fear of so-called disintermediating the banks by introducing these new technologies. Now, we're not here to keep up or to boost bank profits, of course, but we are here as policymakers to ensure financial stability, and a rapid change in the structure of banking would not support financial stability. So, but actually there are ways around it. There are ways you can limit, for instance, the size of wallets that you can have, so the balances that you can hold on wallets, or you can tax them, charge a fee. And that, of course, would go some way towards dissuading people from leaving their commercial bank deposits for instance, CBDC. So this is a concern, but I think it can be addressed to a great extent. Let me just say one thing about financial integrity also. And Brian also provided some really interesting examples of how technology can help. Another one is this notion of tiered wallets. So again, it goes back to what limits you have on wallets. So you can have, for instance, you can imagine having each of you 2 wallets, one with a very low limit that allows for anonymous transactions, and one with a much higher limit but requires you to be fully onboarded. Why would you want to have anonymous transactions? Well, for perfectly legitimate reasons. Maybe I want to surprise my wife by buying her a present I don't want her to know about, by looking at the receipts of the credit card or whatever it is. And thus I would want to transact anonymously, and I could do that with my wallet that has a low limit of a couple of $100, pounds, or pesos, or whatever they are. So that's an interesting development, the idea of tiered wallets. Then in terms of regulation, integrity regulation, etc., I think that and I think Eric has said this, and even if there are entities that are not that do not exist, Bitcoin is not issued by any single entity. It's very hard to regulate something that is not issued by an existing entity. Even in those extreme cases, you can regulate the points of entry and exit, right? The points at which you decide to buy Bitcoin. So you have to go through someone, through an exchange or something. Those can be regulated. And so the extent to which wallets, exchanges, and other such entities have to have a local presence, then there is an avenue for regulation to bite. Liam, you asked me 2 additional questions. Only one stuck to my mind, and that's the SDR question. But what was the other one?
Well, actually, the other one you've answered very eloquently there, which is about why central banks might intervene in what is in a sense a private transaction that may be enabled by private sector providers. Yeah.
So I'd like to say just one more thing, and that is, one of the big points of not necessarily contention, but certainly of debate, is what is the area where the public sector should be active and what is the area where the private sector should be active?
Yeah, exactly.
And in some cases, it's very, very clear. In others, it's much more murky. In fact, even around central bank digital currencies, there's some question. Remember that most of the money that we use today is private. We hold and transact private sector liabilities in the form of bank deposits. That's the money we use. And the public sector comes in by, of course, regulating the banks and also offering infrastructure to facilitate bank-to-bank transactions, RTGS systems, real-time gross settlement systems that run by the central banks, and offering a settlement asset, a common settlement asset, which is very safe, called central bank reserves. So when Bank A pays Bank B, or where customer of Bank A pays customer of Bank B doesn't want to get liabilities of Bank A. It wants to get something much safer, so it gets central bank reserves. So you can solve the problem of interoperability between private institutions by offering a common settlement asset in the form of central bank reserves. So the current system is very much a public-private partnership.
Yeah.
Right? And we need to be very careful of what type of balance we want between the public and private sectors as we move into the digital space. And there's a lot of discussions we should have around that. We shouldn't rush too much. As for the SDR is not really a currency. It's an accounting unit that the IMF uses. And so it's very hard to imagine creating a currency, also because the IMF is not a central bank. One very, very important function of the central bank is to be able to create liquidity in its currency. So when the payment system needs additional liquidity, when a bank needs additional liquidity at the end of the day in order to meet the payment obligation, the central bank can provide that liquidity. Without that, we would be in trouble. The SDR is not offered elastically. The IMF cannot create SDRs out of thin air. And that is a major limitation to imagining the SDR serving as a currency. Nevertheless, what the SDR is a basket of currencies. And you can very well imagine a private provider offering a token that is backed by a basket of currencies that replicates the weights of the SDR. That's possible. And if there's demand for that, maybe somebody will do it. But of course, the regulatory environment needs to be first strengthened in order to issue safe stable coins in which people have full confidence. So anyways, we're just scratching at the surface. We're here to help more. We're here to talk more, and I hope we'll stay in touch.
Actually, the bell will stop ringing in a minute. It's the rise of the House of Commons.
Liam, we can see the sun setting on Big Ben behind you.
I'm going to try and wrap up while having the bell ringing in the background, so bear with me. Thank you, everybody, for what's been a brilliant hour and a half. As you can see, it's something of huge interest to parliamentarians from around the world. And what's been so good about this discussion is that we've got stuck into about 8 or 9 different fields of policy work. So everything from reserves policy through to central bank mandates, through to bank regulation, digital infrastructure, cybercrime, fraud, competition policy, data privacy, consumer protection, and financial literacy. This is a truly complex field of public policy, which is why it's fantastic for the bank and the fund to be engaging with parliamentarians directly, because we're conscious that in most countries, often the bulk of your relationships will be with the Ministry of Finance or indeed with the central bank, but it's parliamentarians that will have to sign off many of the laws across these 9 different areas if we are to really harness the benefits from this new technology in the future. So thank you for giving us such an in-depth discussion in such a short space of time. For those of my parliamentary colleagues on the call still, do let us know how you would like us to continue working as a parliamentary network on this field. I think it is probably a topic in which we'll organise a session at the spring meetings, which will be in Washington, the first half of next year. And we may well have to organise a follow-up session at the annual meetings, which will be in Marrakesh in October. But if there are resources, if there are discussions, if there are briefings that you would find particularly useful, do just let us know and we will do our very best to help facilitate those. I now have to go and finalise our position on the economic crime bill, which is coming to report stage in the House of Commons in January. So this has been a very good introduction for me. But all it leaves me to do is to thank everybody on the call, and in particular to thank our brilliant speakers, Eric Tomaso and Bright Simons. Thank you so much for joining us. Thank you so much for giving us a wonderful discussion today. Thanks very much, everyone, and bye for now.
Thanks.